Today, let's learn what index funds are, how they work, benefits, and also the limitations. There are many questions. Let's begin with what index funds are. Well, they are like a buffet of stocks or bonds that you can buy with one ticket. They are a type of mutual fund or ETF that aim to replicate the performance of a specific basket of underlying investments, such as stocks or bonds. That's confusing. In simple and easy words, let's understand what it is. We all have heard about Sensex or Nifty. Now, Nifty is top 50 stocks in the country and Sensex is top 30 stocks in the country. What the Nifty does? It gives you the average view of where the market is going. The whole point of index fund is to give exposure to the returns of the Nifty. So, if the Nifty is up by 10%, then the Nifty 50 index is also up by 10%. Now, as an EMC, what they do is, whenever they receive cash from an investor, they buy the top 50 stocks in the same proportion as the index. For example, here is a list of some of the top 50 companies listed in Nifty 50. Your money will be invested in the same proportion as the Nifty is showing. The next question is, why would you want to invest in an index fund? Well, there are several benefits of an index fund, such as diversification. Diversification means spreading your money across different types of investments, so that you don't lose everything if one of them fails. Index funds are a type of investment that let you own a small portion of many companies in different sectors and industries, reducing the risk of losing money. And you also get exposure to top performing companies. The second is low cost. Index funds are typically passively managed. That means index funds are cheaper to invest in than other funds because they do not need a lot of people to manage them. Index funds just copy the same stocks or bonds that are in certain group, like Nifty 50. Other funds have a manager who buys and sells stocks or bonds based on their own judgment, and a team who studies the market and give advice. These people charge fees for their work, which makes the fund more expensive. An index fund simply aims to be the market with an autopilot approach that holds the same securities in the same proportion as the index. This results in low fees and expenses for investors. Performance. Index funds tend to perform well over the long term as they capture the average returns of the market. According to the report, legendary investor Warren Buffett has recommended index funds as a safe way to save for retirement, as he believes that in the long term the market will outperform any single investment. Of course, index funds are not perfect and have some drawbacks, such as lack of flexibility. Index funds follow the benchmark index regardless of the state of the market or the opportunities available. This means that they can't take advantage of undervalued or high growth stocks or avoid overvalued or declining stocks. Tracking error. Tracking error is the difference between the return of an index fund and its benchmark index. Index fund may not perfectly match the performance of their benchmark index due to various factors such as fees, rebalancing, dividends, or market fluctuation. Tax inefficiency. Index funds may generate capital gains distribution when they sell securities to rebalance their portfolio or meet investor redemption. The distribution are taxable for investors and may reduce their net return.